morning and good evening wherever you are. Welcome back to another pre-market session here. Happy New Year's, and I hope that you guys have had a good start to your year. I know you haven't seen me on YouTube for a little while, but I just wanted to come in and do a quick update so you guys stay on track with your financial journey. And we have some big news coming up in the next couple of months. So I just wanted to also give you guys a little bit of a sneak peek on that. But let's get into this market breakdown and updates because it's long overdue. And I think a few of you missed me too much because I've got a lot of messages saying, hey, are these ever coming back? And yes, they were coming back. I just have been a little busy with life. You know what happens, and after marriage and yada yada, just been kind of getting into the flow of things. But let's get into it. So just looking at the macro background, we have quite a bit of changes that have been made since the first half of last year. If you look back here and see that in 2024, we had a very different market starting off where the market kind of rallied very hard, right? And now you're seeing the opposite here. This was off the back of 9 rate cuts that were expected. And here now, here we had 9, and here now we are expecting only 1 to 2 rate cuts as of today. Okay. Now this over here, 9 didn't actually come true. We had closer to 5 or 4 rate cuts. And this here is very unlikely to come through at 1 to 2 rate cuts. So you can just see the market has just literally gone the other way completely in terms of being extremely pessimistic about the future. And a lot of things are being priced into this. As you can see, for weeks on end, we've been talking about the 10-year yield and also the dollar index, which have been moving very sharply higher off the back of many different worries of the market. And my way of thinking about this is that when the market has even just one red light on a slew of green lights, right? That's when the market's going to hesitate and it's going to move back and forth. That's what causes increased volatility, right? And the reason why this happens is mainly because now the 10-year yield has gone way up since the end of 2024. In fact, this little bit of sheepishness started in December 2024 after the market saw that there was calming of fears, but then this resumed shortly after Trump won the election for presidency. And now the market is pricing in the possibility of various different things. There are the fears of inflation, okay? Inflation going up. And then there is the fear of also economic slowdown, so recession, okay? And then we also have fears of the 10-year and the dollar index remaining higher for longer, okay? So there are a bunch of things that are going on here. Now, in the macro backdrop, you can also see that cyclically, some of these sectors aren't performing as well, but we'll get into the granular view of the macro in a little bit here. But the main story here is the market is pricing in, once again, 6 to 8 months in ahead, right? A possible higher inflation, stickier inflation, slowdown of the economy performance. And then also the last thing is the jobs market, which has been coming in stronger than usual. And this goes against the Federal Reserve's mandate, because if the job market is strong and the job openings are being filled very effectively, then this means that more people make money, and this means that companies will be spending more on wages, right? And if companies are spending more on wages, what does that bring? That cost of wages gets passed on to the consumer, right? So what does this cause? It causes inflation. Okay, it's an inflationary phenomenon. Okay, so this is what is the main focus of the market right now. And you need to understand this. This is what the market's pricing. We've been talking about this for almost 2 to 3 months now. And I just wanted to come here to so that YouTube has, put this out into the YouTube community because I don't know how many or if you still watch my stuff, which by the way, if you're still watching this video and you are here right now, I want you to drop a comment below and say I'm here, because I actually want to see how many people this video reaches. And if you can, of course, just drop a like on the video so that this video reaches more people. Okay. So the next thing here is the dollar index, and you can see the next level of resistance here is going to be around 110.89, 110.90. That's going to be your next level at which we'll see a retrace. If not, the dollar will make some kind of a liquidity engineering move here and then come back down. But we are on a pretty big wave up, which can go even higher. And of course, if the dollar gets up to 114, that's going to cause a lot of problems, because remember, all of these equities and all of these financial instruments, how do you buy them? You use US dollars to buy them. And if the price of US dollar goes up against all the basket of other currencies, then it dissuades people from purchasing more, because it becomes more expensive to buy these instruments. It doesn't matter what you're buying, right? So the macro is being mainly driven by these various factors, and then the Trump presidency on top of that, with tariffs, uncertainty. What is that going to look like? What is the tax structure going to look like with the new presidency in Trump 2.0? And that's the main focus of the market right now. Do I think it's overblown? Absolutely. I think that the market's gone the completely other way, which shouldn't be the case. So let's get into the little granular view of the market to have a look at where the sectors stand. As you can see, technology, which was a long bullish sector, is now breaking down and coming down for retracements. This is a upward ascending wedge pattern, which is typically a bearish pattern after it consolidates and has broken down. So a break below this 228 level here, right? A break below, and then the rejection after a buy up, which I fully anticipate this to come back into the 230 to 236 range. If it comes back up here and rejects, that will lead to a further retracement back down, potentially to 212 or 203, right? And if we get a bounce strongly off 221, 222 here, and then a confirmation bounce, so that means we move down like this and then bounce and then come back up and then bounce here again, that means that there is a potential more upside into 238. So technology here still in the balance. Remember, I mainly look at technology because this is the biggest sector within the S&P 500. The next biggest sector is financials, which also is going to see earnings this week. So there's a lot for the market to be anxious about, right? And you can see that financials have been growing, a little weaker here over the past couple of weeks after a very, very strong move up on, once again, the Trump presidency being won, right? Financial companies will have deregulation, that's the belief, and monetary policy will be eased, etc., etc. So this is why XLF was performing very, very strongly in the past couple of weeks. But now you're seeing that come back to mean reversion, and there's of course very deep mean reversion for us to go through here if financials do not perform during this earnings season. Okay. Then you have a bunch of other sectors. Let me see. You have, so apart from financials, you have industrials, which have pulled back as well. This also one of the sectors that were bought up on the speculation in Trump presidency. Well, generally, it's an election year kind of sector, right? Industrials are one of the ones that are promised very deeply by electoral candidates. So, now, healthcare is one that has retraced very deeply and tends to be used as a hedge. But this poses a challenge because this sector is not favorable during the Trump presidency, okay? Because Trump is not very pro-healthcare, this is a sector that I expect to be lagging for a little while. So I wouldn't want to go long here until and unless we have secured a bounce above 142 here. And with consumer discretionary, which is XLY, we're also seeing a pullback. Remember, the two stocks that rule this one are Tesla and Amazon. And that's one of the main things that you want to be aware of over here. Needs to pull back a bit more, has, a lot more room to go to the downside, which is at around 212. And then below that would be a big fall. So be aware of that as, this market unfolds. The other sector typically that does well during uncertain times is utilities. But once again, this one has already seen a big move up and is now retracing back. So the market breadth is very, very poor here. Not to mention consumer staples, which, usually is a safe haven when things are uncertain, is now bearish because of higher inflation fears, which erodes consumer spending, which then consumers have to choose between products. And this doesn't bode well for staples, because the consumer will make choices that might not always favor consumer staple stocks. And so you can see a lot of these sectors are being hit, even real estate being hit, right? Just the breadth overall in the market is terrible. Only communications is one of the stronger sectors, and we're seeing a bounce in energy, which is now becoming the de facto defensive playbook against higher inflation, against a bunch of other things. So oil and gas will be your de facto hedge for most playbooks. So if we look at the SPX levels here, technical levels for potential bounces, you'll see that since we've already broken down this 58.29 level, which was a key level, 61.8 support level, the next support might come at 5,700, which was your previous support here. But then below that is a better and more likely support, which is around the 56.50 all the way into 56.75. And if we break below that even further, then it's 55.60 to 55.90. So there's two separate bounce zones here, potential bounce zones, and then way below that you'll see that 5,500 or so becomes a potential support. So there's a lot of big support zones, which I'm not really that scared about or not really that fearful about. But please be aware that there's a lot of people calling for a market crash of 40-50%, and that's just unreasonable, right? If you look at SPY, you'll see that even if we drop down, right, to where that support is, which is in this area here, right, that's going to be an 8% pullback, which is very, very normal in a bull market. And you need this 8% pullback in order for us to grow more in this coming year, okay? But this will also be an ideal moment when we come back here, right, for us to purchase more shares and to add more on these dips for the next bull wave, right? So understand that there is a very high chance that in the short run, so now that we've finished looking at the macro, the short run will see SPX pull back into the 58.50 all the way up to 5,900 potentially in this area, right? And if we get a pullback here, we're going to watch for a rejection for us to go further down. And now remember that there are a bunch of things that are happening in the next couple of weeks that might lead to that. What is happening, you may ask? Well, you can look at the calendar here. You'll see that this week we have CPI coming out, which is your inflation numbers. You'll have, once again, initial jobless claims on Thursday. And then you'll have also Friday and Thursday, we'll see earnings start. So banks will start reporting earnings here. And then heading into these weeks here, you'll have heavy earnings reports all into next week. And the week after that, boom, you have FOMC rate decision, which then in February, the FOMC doesn't meet, okay? So the most important thing to note here is heading into this FOMC meetup, the market's going to have lots of anxiety on what the FOMC decision is going to be. And that's likely going to be a rate halt, or, even if inflation data comes out really badly, then you wouldn't be surprised to see a potential rate hike. And so the market's pricing all of that bad news in now, so that when the news actually hits, then the market will be able to recover. Okay, so understand this so that when the news hits and it's good news or bad news, you understand why the market's moving a certain way. Okay, because I can assure you that even if bad news hits, the market's already priced in, and that will be expected, and that will then become good news, which then the market might rally off. Okay, so that's where we are with the SPX. If you look at NASDAQ now, it's a much clearer support level. You can see that ideally the support level would be 19,900 here, but you have a first support at around 20,200. If we can get a bounce off this level, then a rejection of 20,800, that will then send us back down to test some of these lower levels here, which will then give us another stronger bounce for the upside. A lot of you might be looking at IWM now and thinking, oh, well, this might be a good time to pick up some longs. My recommendation here is to avoid taking longs on IWM because they do not do well in a higher interest rate environment. And the only reason why we had such a big move up on IWM, which I capitalized by taking these two longs here and then playing it up, was because there were expectations of interest rates on the table. Now those expectations have gone in reverse. So you don't want to play this playbook by taking IWM long. Instead, you want to wait for this thing to fully come down, find a bottom, and then when it does bounce, you can play that long. When inflation fears are rolled over, when the interest rate expectations are back to normal, that's when you can play IWM long again. And I'll keep you guys updated when that comes. Okay. And so now looking at the VIX, you'll see today we're up about 10%, which is normal. And the VIX is, been heavily bet on. As long as we don't cross the $24 level, I feel this would be just still not really necessary for us to take aggressive risk on this. But if if I see more action coming into here, I'll announce on the Discord my way of hedging. So right now you don't need to be rushing into that. Okay. Let's do some usual suspects, which I'll cover. So NVIDIA is one of them. I know a lot of you have questions about NVIDIA. Potential support level at 127 all the way to 132. We are in this zone right now. So this is going to be, obviously, this was the target, which we have now hit it for the bearish move down here. But now over here is still not where I would add shares. Remember, my intrinsic value calculation for NVIDIA is around 122. So I wouldn't add shares until we get below 122, which is around 115, which is my average price here, by the way. So if I don't get down below 115, I'm not adding shares of NVIDIA. So that's what I would say. If we bounce here and you still haven't started an NVIDIA position, I would wait a little bit more. If it doesn't come down to 122 and it bounces very strongly here, then you could add some here. But I don't like buying stocks when they're overvalued personally. That's purely up to your risk assignment and your preference. But that's what's likely to happen if it comes down there. Another one is Tesla. I know you guys want to know more about Tesla or know my thoughts about Tesla. Very simple, pattern where it's been consolidating in a descending kind of triangle. And now it's likely going to hit this level again. Its support is going to be around 360 to 370, which is going to be another buy zone here. And we'll see how Tesla deals with this in terms of price action, if it does bounce strongly on it, or does it reject after breaking down from it. So it needs to either do this, and then this, or it does this, and then this, which then may lead or may not lead to a potential retrace and breakout. Okay. And then you have AMD, which I think a lot of people were screaming for, oh, it's a bounce, it's going to go from here, blah, 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 right? And versus the whole time last week, I was saying you guys are getting out over your head and trying to catch a bottom with this. Never try to catch a falling knife, because cheap gets cheaper. This stock's fundamentals are not very good right now, right? And it's losing market share. It doesn't have its competitive advantage, which keeps it afloat. My intrinsic valuation for this is at 114. And if you look at it, it just perfectly kissed the valuation and bounced on it. Not saying that it is accurate or whatever, keep the ego out of it, but it's just, interesting phenomenon that we bounced it around that level. Now, would I add shares of AMD here? No, absolutely not. I don't want to add it here. I want at least a 10% safety margin before I buy shares of this business. Though I own shares at a much lower cost basis, I don't want to add here for no reason, because this could happen and we could keep going down, right? You don't have any confirmation that this thing is bounced. And so you have to kind of add in tranches where you see fit. But would I add here? No, I wouldn't. I personally wouldn't. I would wait till at least we get down in here. You can see that there's a huge disparity in volume. And all of these levels here will lead to this, which is the key support down here at 95, 96. If we do get to 95, 96, I'll be happy to pick up some shares here, but it would only be my first assignment of 1/3 for my portfolio, because I don't believe in the fundamentals of this business just yet until I see that for myself. And then I want to become a long-term investor at a price that is in my comfort zone. So no matter what people tell you, who tells you, oh, you can go long on this. Especially, I don't understand how people would take leverage shares while the stock is going down. That just doesn't make sense to me. Because leveraged shares have a borrowing component in it, which just eats in your returns, right? But I see people doing that, and I don't get it. But you know what? It is what it is. Some people are going to do what they're going to do. And I just say don't catch a falling knife with this one. Okay, just be smart about it. Buy it at the dips, but at attractive levels where you know that you're going to make some money. Now, obviously, I'll do a bunch more ticker breakdowns in further videos, but I know this one is a bit long. Apologies. If you stayed all the way to the end, drop a like and tell me that you stayed to the end. I would love to know who is watching these videos to the end, because truly, I don't think a lot of you do. But let's see. I may get some surprises. I'll see you in the next one. And now that I'm back to my desk and getting back into this full time, I will put more videos out. So if you want to see more. I really like hearing from you guys, so put in the comments, and yeah, we'll see you in the next video. Peace.